Imagine a company, one that's maybe not always top of mind, but is quietly shaping the security of pretty much everywhere we go. Our homes, our
The
workplaces.
blocks, access systems, the whole bit.
Exactly. Now picture them hitting this huge milestone, something they've clearly been building towards for a long time. That's kind of the feeling we're diving into today.
That's right. We're looking at Allegion, global player in security, you know, brands people recognize like Schlage, CISA,
Yeah.
Siemens Voss.
Those names ring a bell. So our mission for this deep dive, as always, is to pull out the really crucial insights from their latest numbers. That's Q2 2025. We want to get beyond just the surface level, understand how they managed this, frankly, historic quarter.
And look at the strategic moves too, right? Acquisitions, tech investments.
Absolutely. And what it all means for the wider security market and, for you listening.
And we've gone through the key documents, the earnings call transcript, the 10Q filing, the press release. So yeah, we're ready to unpack what's really driving things over there.
Okay, let's jump right in then. Because the big news, the headline grabber from Q2 2025, it's a record for Allegion.
It really is. First time ever crossing the billion-dollar mark in quarterly revenue. They hit $1,022 million exactly.
Wow, $1 billion. That's not just a number. That feels like a significant threshold.
It absolutely is. It kind of signals a certain scale and market position. Now, looking closer, that's a 5.8% increase reported compared to last year, Q2 2024.
Okay, 5.8% reported. But what about organically? Because that often tells a clearer story.
Good point. Organically, it was up 3.2%. And that's key, right? Because it strips out things like currency swings, recent acquisitions. It shows the underlying business is growing nicely.
And the CEO, John Stone, sounded, well, pretty proud. Mentioned the team's agility, the business's durability, and really emphasized their execution on capital allocation. Sounds like confidence.
Yeah, immense pride was the phrase used. It suggests their strategy, maybe especially around electronics and software, is really starting to bear fruit and position them well.
So hitting that billion, it signals strong demand, good execution,
Yeah.
basically resilience in what can be a pretty up and down market.
Exactly. Strong proof point.
Okay, so $1 billion, huge milestone. But how did they get there? If we dig into the segments, was there one particular area really carrying the load?
Oh, without a doubt. You look at the numbers, and the America segment just jumps out. That was the real powerhouse.
Okay. How much are we talking?
They reported $821.5 million in revenue just from the Americas. That's up 6.6% reported and a pretty strong 4.5% organically. And importantly, that growth came from both price and volume.
Price and volume. Okay, so not just inflation passed through. And within the Americas, any specific bright spots?
Yeah, the non-residential business was really strong, high single-digit organic growth there. The CEO, Stone, actually said, quote, project demand, project work for our customers and their customers is humming along pretty well.
Humming along pretty well. That sounds positive.
It does. But it wasn't all rosy. The flip side was the residential business. That saw a mid-single-digit decline.
Ah, okay. Any reason given for that?
Yeah, they put it to generally soft markets, and specifically the high interest rate environment impacting housing. And they expect that softness to kind of continue through the rest of 2025.
Right, that makes sense. Higher rates hitting home building and renovation.
But it does highlight, the strength of their non-res side, that it could more than offset the residential softness. Shows some good diversification.
Now, you mentioned electronics earlier. How did that play out in the Americas?
Yeah, this is where it gets really interesting, I think. Electronic product revenue in the Americas surged. We're talking low double-digit percentage growth.
Low double digits. That's significant.
It really is. And it's such a key long-term driver for them, right? Higher margins, potential for software attachment. It's strategic.
Any specific examples on the innovation front there?
Yeah, they highlighted something from their Siemens Voss business.
Yeah.
They're big in electronics. They introduced FortLocks, which is Allegion's first batteryless electronic cylinder.
Batteryless. How does that work?
Well, the details weren't fully laid out, but the implication is it likely uses energy harvesting or power over Ethernet or something similar. The key is no battery changes. That opens up tons of new applications, simplifies installation, maintenance. It's a big deal for convenience and access.
Interesting. Okay. And looking ahead, any other positive signs from the Americas?
Well, Stone also mentioned spec activity. That specification activity has been growing steadily through 2024 and into 2025 so far.
Right. So architects and builders are specifying Allegion products into future projects. That suggests a healthy pipeline.
Exactly. Strong support for their optimistic outlook, as they put it.
Okay, but here's something interesting. You hear about indicators like the ABI, the Architecture Billings Index, maybe being a bit depressed lately, suggesting caution in non-residential construction. Yet Allegion's non-res business is, as you said, humming along. How do they square that?
Yeah, that's a great question, and they addressed it directly. The CEO suggested a few things. One, maybe those traditional indicators like the ABI are a bit disrupted right now. Labor shortages, rapid inflation. They might not be capturing the full picture accurately anymore.
Okay, so the old signals might be noisy.
Possibly. He also pointed to high construction backlogs. Projects already underway are just taking longer, which keeps demand flowing. And crucially, he believes Allegion is actually gaining market share.
Gaining share. From who?
Likely from smaller competitors. He thinks Allegion's stronger supply chain and operational performance are giving them an edge, especially in those consistently strong institutional areas like healthcare and education. Those sectors tend to be pretty resilient regardless of broader economic jitters.
Right, makes sense.
Yeah.
Okay, so strong organic growth, especially in America's non-res and electronics. But that wasn't the whole story for the quarter. They were active with acquisitions too, weren't they?
Oh, very active. It's a core part of their strategy. They talk about balanced and consistent capital allocation, and a clear priority is growth through accretive acquisitions.
Accretive meaning they expect these deals to actually boost earnings per share down the line.
Exactly, not just buying revenue for the sake of it. And they made several moves in Q2 and just into Q3.
What kind of companies are they buying?
It's a mix, but with a definite lean towards strengthening specific areas. On the mechanical side, they picked up Trimco in the Americas architectural hardware accessories and Novas internationally, focused on residential in Australia. Both kind of slot into their existing channels.
Okay, bolstering the core. What else?
Well, the more, let's say, forward-looking moves were in electronics and software. They acquired a German company called Elitek. That deal closed early Q3.
Elitek, what do they do?
Security and access technology manufacturing. Allegion highlighted its attractive growth, high single to low double-digit range, and strong profitability, like mid-20% margins. So it really boosts their global electronics capability and financial profile.
Mid-20s margins, yeah, that's strong. And software, you mentioned SaaS.
Right. Software as a service. They see this as key to differentiating their hardware, making it stickier. They bought two companies here. First, Gatewise.
Gatewise.
Yeah, they provide software for smart access control, specifically for multifamily communities like apartment buildings. Allegion called it a hand-in-glove fit with their own electronic locks and Zontra solutions. It expands their reach to the building perimeter.
Okay, so integrating software with the physical locks. What was the second one?
The second was Waitwhile. They do cloud-based appointment scheduling and queue management.
Scheduling. How does that fit with security?
Well, think about linking a virtual queue, like waiting for service at a bank or healthcare facility, directly to secure physical access. You get buzzed when it's your turn, the door unlocks for you. It streamlines operations, improves the user experience, connects the digital and physical.
Ah, I see. So integrating access control into broader operational workflows. Clever.
Exactly. And taken together, Allegion expects all these acquisitions, Trimco, Novas, Elitek, Gatewise, Waitwhile, to be accretive to their adjusted earnings per share starting 2026 and really boost their long-term growth potential at good margins.
So growth through acquisition is key, but they're also returning value, right?
Yep, staying balanced. They paid out dividends, about $44 million in Q2, and they bought back shares too, around $40 million worth in the quarter, making it $80 million in buybacks for the first half of the year.
Okay, so investing in growth, returning cash to shareholders, that balanced approach seems central. And underpinning all this activity must be pretty solid financials overall.
Yeah, the foundation looks strong. Looking at the Q2 numbers, their adjusted operating margin held flat year over year at 23.7%.
Holding flat despite inflation and other pressures is pretty good, actually.
It really is. They talked about volume leverage, basically, getting more profit out of each additional sale, and a favorable product mix, likely driven by that strong America's non-res and electronics performance. That helped offset higher corporate costs, like incentive pay from the strong results.
And the bottom line, adjusted earnings per share.
Up 4.1% to $2.04. Solid growth.
What about cash flow? Sometimes that tells a different story.
Not here. Cash flow was exceptionally strong. Year-to-date available cash flow hit $275.4 million. That's up gets 56.5% compared to the first half of last year.
Wow, 56.5% increase in cash flow. That's huge.
It is. And it keeps their balance sheet healthy. Net debt to adjusted EBITDA is only 1.5 times. That gives them a lot of flexibility for more investments or acquisitions if they want.
And they're managing pricing effectively too, you mentioned.
Yeah, about 2.6% price realization in Q2, helping offset inflation. And related to that, there was an interesting update on tariffs.
Ah, yes, tariffs. Always a factor for global manufacturers.
Right. They actually lowered their estimate for the full year impact. They initially thought it might be an $80 million hit for 2025, but now they've adjusted that down to $30 million, thanks to some changes in trade rules.
Okay, cutting the expected cost in half is good news.
It is. And crucially, they expect the tariffs to be neutral at the EPS level, meaning they plan to fully offset that $40 million impact through pricing or other efficiencies, so it shouldn't actually hurt their bottom line profit per share.
So managing it proactively. And are they seeing customers maybe ordering ahead to beat potential tariff impacts or demand dropping off?
Apparently not. They said there were no signs of pull-ahead orders, and project activity remains healthy, suggesting demand is holding up fine despite the tariff situation.
Okay. Now, we focus a lot on the Americas.
Yeah.
What about the international segment? You mentioned Novus acquisition there, but how did the overall segment perform?
Yeah, a bit of a different picture internationally.
Yeah.
Revenue was $200.5 million. That was up 2.9% on a reported basis.
Okay.
It was actually down 2.2% organically.
Ah, okay. So acquisitions and maybe currency helped the reported number, but the underlying business saw some pressure.
Exactly. They said the organic decline was mainly due to pressures in their mechanical product lines in some regions. However, that was partially offset by growth in their electronics businesses internationally as well. So that trend holds globally.
And margins internationally, did they hold up despite the organic dip?
They actually improved. Adjusted operating margin internationally increased by 100 basis points, a full percentage point to 13.1%.
How did they manage that with lower organic volume?
Good pricing, productivity improvements, net of inflation, and also the positive impact from accretive acquisitions, like Nova's presumably contributing. They're also actively managing the portfolio. They agreed to sell off a small, non-core locksmithing business in Australia, the API business. Very small, like $6 million revenue in the first half, but it shows they're focusing resources.
Right, streamlining. So putting it all together, the record revenue, the strength in America's non-res, the strategic acquisitions, solid financials, managing tariffs, it sounds like they felt pretty good about the rest of the year.
They definitely did. Based on that strong first half and the continued demand they're seeing, especially in non-residential, they raised their full-year guidance.
Raised guidance. What are they projecting now?
Adjusted EPS outlook is now $8 to $8.15 for the full year. They also bumped up the revenue growth outlook 6.5% to 7.5% reported and 3.5% to 4.5% organically.
And that EPS raise, is it just because Q1 and Q2 were so strong, or do they expect the second half to accelerate?
They made a point of saying it's not all back-end loaded. It reflects the strong performance already delivered, plus the positive impact expected from the new acquisitions and updated currency rates. So it signals confidence across the board, really.
Okay, so wrapping this up, what's really striking here is Allegion's performance in what they themselves call a dynamic environment. It's not exactly smooth sailing out there for everyone.
No, definitely not. But they managed to hit that historic billion-dollar revenue mark. They've clearly made smart strategic bets, especially expanding in electronics and software through those acquisitions. And the financial management looks very disciplined.
Yeah, that resilience in the America's non-residential business, even with mixed economic signals, really stands out. And the balanced capital allocation investing for growth but also returning cash seems like a solid formula for them.
It paints a picture of a company that knows where it's going and is executing well against its plan for, continued profitable expansion.
So given everything we've discussed, especially that strategic push into electronics and integrating saws, here's a final thought for you, the listener, to chew on. How might this increasing blend, this convergence of physical security hardware and digital access software, fundamentally change how we think about safety and convenience in the next few years? Not just in big buildings, but maybe closer at home, too.